joining me now is Rob Towell from Sasfin Securities to give us his take on the market's activity. Rob, thanks so much for your time this afternoon. Now, we know that monetary policy is in focus today, with traders eyeing, of course, Fed Chair Jay Powell's address at the Economic Symposium in Wyoming later today. What will you be looking out for? Hints on when cuts will start coming through. There's also been conversation around the independence of the Fed. What will you be watching when it comes to that speech?
I don't think Powell is going to say whether he's going to do cuts or not. So I think it'll be the type of feel that he gives to the market, whether he will do cuts in September. But there are two CPI numbers to come through before the rate cut, and I think he's really going to wait for those. So I don't think he's going to give too much to the market, and I think it'll be probably deemed maybe as slightly negative for the market. So I don't think you're going to get too much out of Powell over this over Jackson Hole.
And I mean, we've been seeing that markets, or market participants in particular, have been quite nervous when it comes to picking up equities. Trade so far this week pretty choppy, even with some of those U.S. retail earnings coming through, some looking good, some not looking good. We've also seen a tech sell-off. Is this just evidence that traders are nervous and they're just holding back until we hear from Fed Chair Powell?
Yes, I think so. You saw some profit taking coming in on the big tech stocks, even though their earnings have been relatively solid over the last period, and in the quarterly earnings were all very, very firm. But you definitely saw some selling coming in there. And I think obviously the buyers are waiting to see if you're going to get that interest rate cut. I mean, the market is, I think it's 75% that the market is pricing that there will be a cut. So if there isn't a cut, I think that will be a trigger later in September for a really large sell-off. So I think people are a little bit nervous, and therefore you are seeing some profit taking. But it also gives you opportunities maybe to enter some counters that get sold off too much over the period. And then locally, I mean, it does also affect us. If they do suggest that there's an interest rate cut, it helps us maybe possibly later on in the year get another cut in South Africa. So you're starting to see a little bit of interest. The rand is firming as well. And you're starting to see some interest in our retailers as well.
All right, so let's move over to what's playing out here at home, with company earnings picking up, a glittering gold price really working in Gold Fields' benefit, with the miner posting a 24% jump in production and HEPS more than triple. Just your analysis of those numbers. I guess really nothing to be surprised about here, right?
So the last 6 months numbers before this were a surprise, when they actually had a few once-off costs, and therefore they didn't produce the type of revenues that you were expecting. So obviously that was then priced in, that they were once-off items. So this set of numbers is expected, and even though they're stellar numbers, you can see that the share price has hardly moved today. It's slightly negative. But the longer the gold price stays at above $3,000, the gold miners are all making really good money, and we don't see the gold price really going below 3,000 in the short term. So I think you'll get definitely another 6 months set of earnings where you're going to get really good set of numbers, and then we'll have to see, maybe we get into the top of the gold market, but a very good set of numbers. And I see that some of their costs have also come down in that set of numbers, which is important for Gold Fields. But all the gold counters really, at the gold price currently at 3,300, you're going to, you really are seeing, stellar earnings come out from them.
And what have you made of Grindrod's numbers, Rob? Ports and terminals looking good, but we are still seeing, a downbeat showing from the logistics segment. Softer commodity prices also not working in the benefit of the group. But I see that the share price is up over 8%. Is this on the back of the payout and the special dividend?
Yeah, I think the special dividend was a bit of a surprise.
Okay.
But the ports in Maputo, they had a bit of a weak December when there were riots last year. So you're starting to see a big recovery from Grindrod on that side, and you're starting to see them pay back that to shareholders. So I think the special dividend's definitely seen as a bonus, and I think that you're starting to see the rail in South Africa start to improve as well. So they're in a very good situation. As long as you start to carry on seeing these improvements in rail in South Africa, as well as the growth in Maputo. So on a valuation level, they're not too expensive, and paying back shareholders with the special dividend, I think it's a good counter to hold for the foreseeable future.
Now, an upbeat second half, giving Adcock Ingram a boost, somewhat offsetting the downbeat performance we saw in the first half. Both revenue and HEPS up a similar margin, up about 1%. Tepid growth, but I guess growth nonetheless, hey?
Yes, I mean, they were negative in the first half of the year, so obviously the 1% overall shows you that they're in the last 6 months are probably maybe 4 or 5% up. So not massive. I think what was very positive and why the share price is up again today is that they're paying a dividend plus the payout for the deal at 75 rand. So theoretically, it makes the deal at 76 rand now, which is because 76 rand 60 because you're starting to get that dividend, and therefore you saw the share price pop up a bit. But not long to go before they get bought out. There's still 6% in it probably. Some people might take that depending on the time of the deal, as a guarantee for a few months. So all looking good, but we are going to lose them as one of the shares to buy on the exchange.
And sticking in that sector, that pharmaceutical-like sector, Aspen now expects to report a loss per share, pointing to impairment costs. Markets really punishing the group. I think the last time I checked, that share price was down over 10%. What have you made of the update? I mean, this stock has been beaten for quite some time now. We also saw really hectic downward movement when it reported of the contractual dispute earlier this year.
So I think the share price, was over 200 rand probably a year ago. So it's dropped all the way down to, I think it's below 100 today. A very bad set of numbers. The write-offs across the board, across multiple different sectors. Not many sectors really producing good revenues at all. And I think the market's just getting really tired of all of these setbacks that they had. It's not necessarily something that they've done by themselves.
Yeah,
it's the market itself. They had one very big contract that the contractor pulled out. They now have got litigation against that. So these things could all come right in the next 6 months. And into 2026, Stephen Sard says you will start to see revenue recover. It's not for the faint-hearted. I think possibly, there could be quite a good recovery in Aspen from these levels, but we're not recommending it at the moment for clients. And I think, they've still got a long way to go to prove that all of their new facilities, will start to produce long-term revenue, not just once-off revenue, but long-term revenue growth. And I think for now, only the, very aggressive traders would be picking up Aspen for the next 6 months.
All right, let's hit pause on the conversation, Rob. Before we move on to your stock pick, let's take a moment to touch on what counters your industry peers are watching closely.
I'm picking Process tonight. I have picked it earlier in the year as well. We still really like the Tencent business. Just recently had the Q2 earnings. And revenue's growing at 15%, gross profits growing at 22%. We think that even in 3 years' time, we think that the earnings are still growing at close to 20%, and you're paying a much lower multiple for these earnings. You're paying a 21 times multiple for these earnings, and on that basis, you get kind of a return of 18% a year in rands. Plus, on top of that, you've got Belosi, the new CEO of Process, and he's heavily incentivized to grow the businesses outside of Tencent. So Process owns Tencent, which is about 90% of the asset value, and he's heavily incentivized to grow the remaining 10%. I think that he will do well. He yesterday put out his CEO letters on their website. And he is going into, he also wants to build an ecosystem business. So if you think about Tencent, WeChat as being an ecosystem, you log on to WeChat, you can buy things on WeChat, you can pay for things on WeChat. He wants to do the same, but his starting point, he says, is going to be in the food delivery business.
I'm paying for Discovery Health. I think you're going into a nice situation where they've got some of the maturing business, the life and the health that's been there a long time, and that's like the cash cow. And then a lot of the investments that they've been making into organic growth, be it in China or gaining traction through Ping An and some of the other areas in Vitality Global, and you're seeing the Discovery Bank monetizing a lot quicker. So I feel like the requirement to invest is reducing, and they can start focusing on the profitability and monetizing these growth opportunities. And I think you're going to see that continue over the next few years. You're going to see more profitability, more margin expansion, less capex, so more cash flow generation. And I think to me that looks attractive, and I think it's a good entry point. It's been consolidating. It had a good move last year, but it hasn't really gone anywhere this year. So I think it's giving us a nice opportunity.
So, Grant, going with the discovery and market picking process, just your analysis on those counters, Rob?
We really like Process. We own Process across the board in all our portfolios. They've got a share buyback. Tencent has got a share buyback as well. So that's supporting both stocks. For the first time, their own businesses started to generate free cash flow and start to produce profits away from Tencent. So we really like Process, and I think even though it's had a very good year, a year and a half, I still think you can buy Process. So we really like that. On Discovery side, we like Discovery. We don't own it at the moment. It had a very big run last year. As Grant said, it hasn't done much this year. But the bank now, is profitable, and the cost and capex into that bank has fallen away. And then obviously they've still got Ping An in China, and Ping An can grow, quite rapidly in China. So I think that it's a fair asset to buy if you want to go into financials, but we don't own it at the moment.
All right, so then where are you seeing opportunity at the moment? What's your stock pick?
So, we still like South African banks. We own FirstRand and Capitec, as well as Standard Bank in our portfolio. So we still like this sector. Standard Bank came out with really good numbers. So did Capitec. Absa came out with relatively solid numbers as well. So that's a sector that we like locally. And at the moment, we still like FirstRand. I think it was my stock pick the last time.
Yeah.
It's very well situated within lending, business, and mortgages. And we think that you can still make good returns on FirstRand at these levels.
All right, Rob, thanks so much for your time and sharing your insights today. That was Rob Towell from Sasfin Securities.